Joining us today is the JV Jedi himself, Mr. Russell Westcott. Russell, I feel like you don't need an introduction. People should already know who you are. But for those poor souls who just don't, could you tell our listeners a little bit about yourself, how you got started in real estate, and your journey to this point?
Oh, wow. Well, there's a big question. But first of all, El Ray, thank you very much. I'm very honored to have this conversation. It was about, what was it, 1 month ago? I get so mixed up. Some of these months are just all blending in together. I was out presenting at the Mogul Mastermind group out in Edmonton, and we connected out there. And so a couple things first for you. Number one is you're doing a hell of a job with what you're doing with this podcast and providing some really good top-notch quality content and interviews with some of the players. I'm not lumping myself in with that category yet, but and you're just helping and you're serving, and most importantly, I wanted to congratulate you. I understand you just recently got licensed in the beautiful city of Edmonton under the Mogul team, and you're out there pounding the pavement and finding really good deals and opportunities for investor clients. So I just wanted to congratulate you and wish you all the best on this new journey that you're on, my brother.
Thank you, Russell. I appreciate that. Thanks, man.
I didn't try to deflect that question, but sometimes it's, us typical Canadians, sometimes we're very humble and we're very shy. And the last thing we want to talk about is ourselves, right? So I'll try my best to answer that question. How did I get started in real estate? And I've told this story different times and told it many different times. And I'm sure if people are listening on my podcast or your podcast or seen things, they've heard it. But I'm going to share maybe a different take on my how I got started. How I really got started was I was climbing the corporate ladder with work. I was working for, at that time, Kraft Foods. I started in Saskatoon, and then I was in like 4 different cities in Western Canada. I was out in Vancouver, and I was renting a basement suite with a roommate, and out there. And I had that birthday that kicked in, one of those birthdays that has the 0 at the end. So I turned 30, right? And from a self-diagnosed Peter Pan syndrome, I was asked the question is, what do I want to do when I actually grow up, and things like that. And I noticed that it was going down the path was not going the right direction. It really wasn't. So I had to make some pivots and some hard changes. And lo and behold, like many people's story that you've probably have heard, they discovered Rich Dad, Poor Dad, Robert Kiyosaki, devoured that book. It changed my life on a course of action I was going. And then at that time, I just slowly got into real estate, and I had no business being a real estate investor. I grew up in small town Saskatchewan. I grew up in a mobile home park, and I had never even bought a property until into my 30s. So I had no experience. But what the hell? Let's just dive in with both feet and let's just sink or swim, and let's figure it out. So really got hooked on real estate. I have lots of stories. Each property that you buy has a different story on things. And I have a really fun story I could share with your listeners as well about how something from 20 years ago has actually come full circle and has surfaced again for me here. But this is your show. I just want to make sure I'm here to help and serve.
Russell, firstly, if we everyone listening out there, Russell has this like control panel where he has a whole bunch of effects. I feel like just after that, you could just drop a bomb.
Well, if you want. So I'm dropping some fire. Ooh, wee, it's getting hot in here, brother. Hang on. Sorry.
You know what I love, Russell, is the fact that you highlighted your age and where you got started. I think a lot of people feel like, is it too late? Should I have started? I wish I had started a whole lot earlier. And the fact that you decided from your 30th birthday to make that pivot, that in itself, I feel like is very inspirational for a lot of listeners out there, is that it's never too late to get started and pursue that path of real estate investing.
I would just add to that, El Ray, is it's never too late and it's never too early, to be honest. I strongly encourage many of the people that I'm working with, many people I'm coaching and helping out right now are by and large in late 20s, early 30s, fairly new marriage, brand new babies, in many cases, and they're all sitting there going, holy macaroni, I've got these 2 beautiful little babies here. Now what? Right? Yeah. And then, so they're just looking for people that have been down the path before them, people who have made all the mistakes, people who have stepped on all the landmines, people that have 20 plus years of experience of doing that. And those are the people that I'm working with now. And I had one of those, to take this story another chapter, on another birthday about a few years ago, another one that ended with zero. On my 50th birthday, I had another one of those moments. Was, have I done enough? Have I contributed enough? Have
Yeah.
I poured into my community? Have I paid back everything that I've learned to more people? Have I grown my audience and inspired a new generation of real estate investors? Have I done that? And if I was to be brutally honest, my answer is no way. I haven't even come close to doing that. So at that time, that's when I decided to start doing more podcasting, more YouTube channels, getting on things like this, doing more live stage presentations, and just, it's my obligation to share with the next generation of people of all the mistakes I've made, all the wins I've had, but more importantly, what are the biggest lessons I've learned, so people don't have as painful of a journey going forward as I potentially had along the way.
I love that. And that is such a strong why. And I think that's why we were chatting before this about how much you've put out there and how much you've done. And the why matches the performance that you've put out there. Now, Russell, I've gotten a few of these questions. Just this last year, 2 years actually, has been quite the roller coaster for investors, right? A lot of ups, a lot of downs. Can you share your experience as an investor in Alberta more specifically, how economic factors influence your investment decisions?
Yeah. Now there's a big one, and we'll take some time and unpack that. But here's what I'm going to share with to start that conversation context. So I have the great honor and privilege of working with people across the country. Okay. Literally from Vancouver Island to Atlantic Canada and everywhere in between. I've got, yeah, absolute clients in Manitoba as well. Um, Real estate is local, and not only just local, it's actually extremely hyper local at the same time. Because, for example, what some people are filling out in Ontario and British Columbia might be completely different. If they said what they're filling out in Ontario, where the market's starting to gyrate a little bit, prices have maybe come down over the last year, they start to go back up again, then all of a sudden interest rates kick in again and people getting jittery again, and listings are starting to grow, and people's are collapsing contracts, and people in Ontario are just going, geez, the market's very roller coasterish right now. However, if we go to Edmonton or Calgary, and you're sitting there and you talk to somebody who's investing in, say, Calgary or Edmonton, and they're going, geez, we can't even find inventory right now. We have 200 applications for rental people coming through. Our rents are going up significantly. I need to get more properties under my belt, right? So everything is completely localized, and it's hyper local. Okay. So because there'll be a national audience that will listen to this. So I just wanted to just frame that for everybody first. But we will definitely talk Alberta, because that's kind of near and dear to both of our hearts. That's where you're a licensed agent in Edmonton. I live in Vancouver, suburb of Vancouver, but I invest out in Alberta. And there's a lot of really positive things going on in Alberta right now. Like it's crazy to think about some of the activities that are going on. And now, don't get me wrong, we had a 15-year flatness at best, where nothing was going on. It was just flat, if not a little down, little up, whatever, for 15 years. Finally, over this past year, and I think the next growth cycle in Alberta is just starting now. Like there's going to be another 7 to 10 year significant run up in the Alberta marketplace of many things that are happening. And that's, I'm going as hard as I possibly can right now to get as many projects undergo right now. This week alone, we had 4 offers accepted, and we literally have 19 units in construction mode right now. And I'm actively searching out for more, because I believe there's a huge window of opportunity in Alberta right now, and we can go many different directions on that conversation. So how's that for a start?
I love it. I can't wait to unpack it, to be honest. I'm excited.
Succeed
in real estate investing, focus on networking and building a strong power team. As an investor-focused realtor in Edmonton, I can connect you with local events and experts, plus keep you in the loop with exclusive deals. Contact me below to start growing your network. and your net worth today. Let's get back to it. When evaluating potential real estate investments in Alberta, what are some key economic indicators that you're considering? Now, I know you said things are starting to ramp up. What are you looking for?
Yeah. Okay. So the framework that I look at is, now you can go extremely in depth and you can geek out onto every stats can and every report you can find out there. I like to, and don't get me wrong, please do, and please go into it. And the deeper you unpack it and the deeper you go in the layers of the onion deeper, the more the answer, in my opinion, will keep coming out to the same answer. But here's my simple 3 framework of analyzing a market. So if we were to do a Venn diagram, so I'm going to try to, there's a, you know what a Venn diagram is? If you have 3 circles of a Venn diagram and then there's something in the middle. Okay. So circle number 1 of the Venn diagram is economic activity. Okay. And I'll unpack these each more, but I'll just talk about what are the 3 circles first. So economic activity is number 1. The second one is the people, population, where people are moving, migrations, things like that. And then the third one is market. So economic, then people, then market. Okay, so let's bust down the first one. Economic activity. Is the economy churning in your marketplace? And then how do you find those numbers out? You find that out through GDP. Where's the GDP going? Is the GDP going up? Is it flat? Is it down? How's it compared to the national number? In Alberta right now, GDP is leading the country, and it's forecasted to lead the country for the next couple of years. Quite easy. And I honestly think they've understated the GDP activity that's going on. The next is infrastructure, like infrastructure spending. Are there projects being approved in the area? Are there new roads and streets and LRTs and big giant industrial projects going on? Like right now, and I think I heard it at your guys' event last month in Edmonton, there's 200 capital projects going on in the city of Edmonton right now. Like, honest to goodness, go drive the West LRT line where the new stations and everything's going there. And first of all, everybody's upset that there's all this stuff going on and there's traffic jams and everything there.
Yeah.
I drove that the last time and I was stuck in traffic and stuck in all the construction. And I was sitting there rubbing my hands together because that's what you look for. You look for those things. You look for that activity. There's billion-dollar projects. Like go jump onto the Industrial Heartland website. And I think it's, something like $45 billion worth of projects that are planned up there. And some, tens of thousands of jobs that are planned up there. Okay. So I think that's industrialheartland.com or industrialheartland.ca. So you just go through that, or you go and you drive through different areas. Just go take a drive up into, the Blatchford area or Griesbach, and then just go through and just check out all the building, all the construction that's going on. Now, why is all this economic activity happening? Is because people are coming into Alberta again. If you actually look at, if you can find an interprovincial migration or immigration graphs, you'll see that Alberta is setting records again. They're setting a record about the amount of people moving into the cities. Edmonton is forecasted to add another 1 million more people in the next 15 to 20 years, right? And if you're going to add another 1 million people to a population of 1 million plus, it doesn't take my 6th grade Saskatchewan education to figure out that that's probably going to double in 15 years. Then the question you're going to ask is, where's everybody going to live? Where's everybody going to rent? And if you actually then go follow it back even further, and this is getting into the market a little bit, you will find over the last couple of years, there's actually been a shortage of new houses being built over the last couple of years, right? So the challenge that's going to have, and I've made this prediction, and I forecast by spring of 2024 in Edmonton, there's going to be a shortage of new houses that are available for people to take possession of. So the market is going to jump up even more. The other forecast I've just recently seen is that Alberta is forecasted to surpass British Columbia in the next 15 to 20 years as the 3rd most populous province in the country. Okay. So if you have people moving in, if you have positive migration of people moving in, and you actually have a little bit of a shortage of houses that are on, like, go talk to somebody in Calgary. There's 100% there's a shortage, and what happens in Calgary will move up to Edmonton. Um, it's very positive for what you don't need to be a rocket surgeon to figure out all those kind of things of what's going on in the marketplace. Now, so when you start factoring in the people, so then now I take a look at the people. Okay, are the people working in Alberta? Absolutely. If you need a job, Alberta's calling. Go to Alberta, get a job. Okay, so they're working. Are they earning more money? Absolutely. They're earning. Alberta has some of the highest wages in the country out there right now. So the people earn more money. Now, do they keep more money? Well, 100%, because they have some of the most highest disposable incomes in the marketplace. You don't have PSTs. I think your liquor taxes are lower, smoke taxes are lower, gas taxes are lower. You're paying $1.20 for gas. We're paying $2.10 for gas out here in Vancouver. Okay. So you have more money in your pocket. What happens when you have more money in your pocket? You spend it on things. You buy cars, you buy boats, you take trips, you buy houses, things like that. Okay. So you have all that. And then especially because Alberta market is affordable, which we'll get into the affordability numbers here in a second. Once we get into that kind of thing, what you're finding is an awful lot of people that are moving to Alberta just because it's affordable. And mainly the people that are moving to Alberta are younger people, younger, mid-20s, late 20s, early 30s, younger population moving in. They're looking to potentially buy a house with a yard, potentially start a family, work, earn money, spend more money in the economy. And you're seeing the average age in Alberta is starting to go down there. That's a very positive sign for an economic growth of what's going to happen in the housing market, because you start getting those people coming in, they're younger and they spend more money, right? And they're going to look to buy a house. That's very positive for the housing market. Okay, so then the third part of the Venn diagram is talking about the housing market. Right now, the supply-demand curve within Edmonton is very balanced. Calgary, it's out of whack at the moment. Way too much demand, too little supply. But that's going to come to Edmonton very soon. But right now, it's balanced. But the most important thing is the market is affordable. Like, you honestly can get into a really nice house in Edmonton, and let's just say you had a rental helper of a basement suite. You could get into that for $500,000 to $550,000 for a brand new house and have a $1,100 mortgage helper in your basement, right? So compare that to out in many other markets where you have to pay $800,000 for a townhouse in some markets like that. So lots of people are moving in, the supply and the demand, the housing inventory is getting to a point where I just see nothing but positive momentum going on. And I also see positive momentum on the rental market as well. Sorry, I'm going a little bit fast and a little bit off tangent here, but can you tell I'm excited? Can you tell I'm excited about what's going on?
I absolutely can.
So no, and not only am I excited, and that's what the research is pointing to. We're putting ours and our investment partners and our capital partners, we're putting that capital to work at the same time. Like, we're putting literally where the mouth is, and we're trying to get as many opportunities as we see fit. And there's just some crazy deals that are happening. Deals, maybe the best way to describe it, crazy opportunities that are happening within infill in Edmonton right now too, of being able to take a piece of land that has some very favorable subdivision that you can subdivide, and where there was once one, it now turns into 6 or more. Okay, like, it's huge. Like, I haven't seen this opportunity in like 20 years in some respects.
Oh, 100%. So much of what you say just hit so hard there, because you are absolutely right. I have people from all over the country that there's investors, and then people that are just moving because barrier of entry is so much lower the side to get in on an investing standpoint. And then for just your standard homeowner, you get so much more home, right?
Yep.
Zoning is a lot more favorable, and there's a lot of potential to be adding more units to land. So everything that you said there was it was getting me fired up there, Russell. So no, believe me, you didn't go off on a tangent. I was loving it. I just wanted you to keep going. I'm like, to be honest, Russell could be running this podcast by himself. By the way, for everyone listening, Russell has his own. So I'm going to leave that in the description. Please go check it out. Now, Russell, are there any particular regions or cities in Alberta that you find especially attractive?
I work with clients that love Calgary and the Calgary area. I have some clients that are doing extremely well in Lethbridge right now too. I have a
Yeah.
client out on one of the Vancouver Islands that he's buying up small to medium sized apartment buildings in rural Alberta, in the Innisfails, in the Brooks, in the Medicine Hats, and he's just
Yes.
filling all that with all those small and mid tier apartment buildings and those. And I think he's doubled his portfolio in the last 12 months. So everybody's a little bit different. Or I have a good friend of mine that's just crushing it up in Grand Prairie right now too, on things like that. Some markets are doing very well, and then in some markets in Alberta are not doing as that great. Like, to be honest, I have some properties up in Peace River, and Peace River's dead at the moment. I just wish that all the stuff that's going on in Grand Prairie would just flow over to Peace River, but it's not flowing over there. So my model typically is I like to stick to the bigger centers. I like to stick between the corridor between Calgary and Edmonton. I think that's where the bulk of the population and growth that's going to happen, is that corridor between Calgary and Edmonton. And my primary model that I like to look at is in Edmonton, just because of the favorability of what I call the perfect storm. Okay. Now, the perfect storm up in Edmonton right now, in a good way, don't get me wrong, a perfect storm can actually crush you at the same time. But this is a perfect storm in a good thing. Number one,
Yeah.
the perfect storm in a good way is the densification rules have just recently changed in Edmonton. Okay. And you have an opportunity to essentially take one piece of land and subdivide and add up. When you're done, you can have up to 6 to 8 and or more in many respects. So the densification rules
Yeah.
have just completely changed the game. The second number is what we talked about earlier, that 3 perfect storm, is all the economic fundamentals have just really pointed positive. So we've talked in depth about that today. And then the third perfect storm that's just surfaced up is then there's some financing opportunities, some financing products that have just come out that I haven't in 20 years seen this good of an opportunity. Like, in 20 years. And I'm specifically talking about the MLI Select program, where you literally can get into a multi-unit property for 5% down, 50-year amortizations, discounted rates, and you can get into that. I haven't seen a product like that in 23 years of doing this. So if you factor in the densification rules, okay, the economic activity, and the financing opportunities, sign me up, brother. I'm going to, as hard as I can, to really to fill as many orders as I can for the next 3 to 5 years. I'm going to town. So watch out, Edmontonians. We're buying it up on you.
I've noticed that. I noticed there's a lot of competition, and I think a lot of it comes from other provinces. I think people have caught on. Russell, you've been spreading this too far out, man.
Well, I should maybe, what it was, a master angler never shares his fishing hole, right? So I should probably stop this. Okay, so everybody that's listening to this, just rewind like 25 minutes ago and just ignore everything I just said. Please, Edmonton is closed for business. Do not invest in Edmonton.
Now, Russell, I know you alluded to the MLI, and I think people are going crazy for that. Do you find that there's still opportunities in the residential space, given all the incentives that's pushing towards the commercial multifamily side? Are you still investing on the residential side as well?
Well, I'm. Do you want me to let you in on a secret here? Is your audience? Would your audience like a little secret? The really cool thing is, if you do it well, you can do both at the same time.
I was hoping you'd mention that.
That's what we're doing right now, especially if you can start combining multiple single family properties together over one umbrella. You can actually get a commercial lending over the whole package. Now, it's to be honest, a lot of people don't know. Some people do, probably if they listen to your podcast or my podcast, they know this. But there is truly an opportunity that's just literally just opened up over the last little while. I'm hesitant to share all this because I know lots of people will be asking questions and stuff like that, but it is this good. Honestly, the analogy I use is, remember the old IKEA commercial where the couple was sitting in the car and the spouse was in there shopping, and she got such good deals and such good opportunities. She used to go there, start the car, because I think they stole something almost. That's what I'm sharing with people right now is happening. Like you literally, if you can get, like, I'll give you an example. This is something that we're writing on and we're just getting the numbers together right now. If you can get, because the zoning bylaws have changed, if you can get a house, you can put a suite into it and a garage suite on it on one property. Okay, so 3 units. That just changed. Before you could either have a basement suite or a garage suite. You couldn't have both. Now you can have both. So some people's going, well, that's 3 units, Russ. You can't get commercial financing for that. But if you can get 2 of them side by each, you now have 6 units. Or if you can get 3 of them side by each, you now have 9, 3, 6, 9, 12, 15. You're now doing it like Lego. Okay. And you literally, let's say you just get 2, you can get 2 lots beside each other where you can build those 3 house combos on it. You can put 1 commercial umbrella over it over 6 units, and you can get that MLI Select program. And in many cases, applying for commercial financing, there's lots of criteria and there's lots of red tape, and it takes a long time, and there's lots of fine print, and there's lots of hoops and jumps and firstborns that you have to sign over to and all the qualification. But in that realm, if you qualify and your partners qualify, there really is no cap on how many mortgages you potentially get. As a matter of fact, in the commercial world, they sit there and go, you have lots of properties. All right, celebrate. More the better your application is. They don't cap you at 5 properties. They don't cap you at those kind of things. Like, don't get me wrong, it's expensive money. Like, it's extremely expensive. But if you're able to get extremely good terms, by all means, it's not the cost of the money, it's the availability of the money that matters more. And one of the projects we're doing right now just got an offer accepted out in Beaumont right now, where we have 3 lots putting together. We're going to be building 3 townhomes on them, all joined together. The 2 outside ones will have basement suites in it. Suites. And then we have 2 suites in the garage. So we actually have a 7-unit build going over 3 lots. And we're able to get a commercial umbrella financing over top of that. Okay. So I'm hesitant about putting it out there, but you know what? My strategy and my motto is just share everything. I'm here to help and serve and help others take advantage of these opportunities. But this is an opportunity that I haven't seen in 20 years, truly. And gang, don't sleep on this. Really learn about it, get involved in it. And I have a fun story to share about the one that got away, a little regret. You have a moment for a story there, Elray?
Please.
Okay.
Please dive right in.
Okay, so the story goes as follows, and it's I'm gonna really challenge all the memory cells here a little bit on the old memory bank on the computer. I might have to do a hard reboot on the old computer, but this was let's call it 2003 when I first got started. So 20 years ago. Okay. I had bought maybe a place or 2 in Edmonton. I had bought a couple townhouses in Edmonton for, like the $80,000 range. And I'm a baller. I'm the king of the world. Like, everything's great. And where I was living in Burnaby, British Columbia, still renting with my roommate, we lived in a basement suite. I was noticing in our area, in our neighborhood, that I was noticing houses were being knocked down. And I was just kind of following and watching. And then all of a sudden they were starting to build new houses. They were building a front and back duplex on that. So essentially, where there was 1 house, they subdivided the land, put on a front and back duplex. So where there was once 1, there's now 4. Okay. So I was in there, interesting. I just got into real estate and I thought that was kind of exciting and stuff. So I noticed beside me, I would go out and I'd pick the blueberries and the blackberries in this empty lot beside us where we lived. And I go, I wonder if this piece of land here would work for something like that. So I, lo and behold, went down to the city hall and tracked down the owner and wrote them a couple letters. Yeah, mail, right? The old snail mail. And they got back to me and they said, yeah, sure, we'd love to sell you the property. It's $460,000. I might, what? $460,000? I've never bought a property, and the highest property I've ever bought had a house on it that I could rent for, and it was $80,000. And I'm just about had a heart attack. And then so, I was way too scared. I was just too scared. Fear got the best of me. Didn't pull the trigger, but I watched the neighborhood still develop. And I did finally meet with a person that told me some of the numbers of what they were doing. They bought the property, they subdivided it, and then they built on it, and they had front and back duplexes. So they bought the property for, let's say, $450,000. They put about $1.4 million and change into it. They're into it with all their costs for about 1.8, 1.85, and they sold each of those half duplexes for 500,000 each. So they sold it for 2 million, and their costs were about 1.8 to 1.85. So they made a couple $100,000 on doing a transaction like that. I go, if I would have known that, I could have done things a little bit differently. Okay, so that was 20 years ago. I just pulled up in that same neighborhood. I just pulled up what those half duplexes are selling for. They're each selling for $1.3 million now. 1.3. So 1.3 times 4, what is that? $5.2 million. So 20 years ago, I could have potentially built those for 1.8 and change. They'd be worth 5.2 and change today. Okay. And arguably speaking, if I would have been able to rent them and find a way to rent them out over 20 years, they could be potentially be free and clear. With that one transaction, I could have never had to do another deal again with that one transaction. So the point I said to myself, this point I said to myself was, if I ever see something like that happen again, don't be so scared, you know what, to pull the trigger again. And I just shared with you some things that are happening in Edmonton, that I'm buying land positions right now in the 300 range or less. I think we just bought one for 280, 269, 283. I think it was 283 for a 7,500 square foot lot, 50 by 150 or 50 by 148. There's some of them are different sizes for under $300,000. They can be subdivided. And when you're done, you can have 2 houses with 6 units over the 2 of them. Okay. And our build costs are going to be, let's call it roughly like 1.7 million. Yeah. So I'm seeing an awful lot of the same numbers starting to surface again that I saw 20 years ago in Burnaby, British Columbia. Now, I'm not here to say in any way, shape, or form Edmonton is going to go to Burnaby, British Columbia numbers. But I can guarantee when I'm running my calculations, if I'm building a 6-unit property for $1.7 million and I'm getting the financing from CMHC with fairly low down payment after we're all said and done, and when I run my cash flow calculations, they are positive cash flow on a fairly significant basis. I can sit 10 years and I can wait, and hopefully that may become, it may never come to those valuations, but I can sit for 10 years and I can wait for all the market appreciation to kick in at that time, because I'm sitting on some good assets in good areas that attract amazing tenant profiles and they cash flow.
I think you spoke about this in one of your podcast episodes, but I am noticing that that's where the opportunity lies for sure. There's a lot of properties that are up for sale that you're just getting them at lot value. The houses are ready to be demoed, and it's a big size lot, and there's just so much potential in it. And you're absolutely right. There's big opportunity there. Now, Russell, I just want to go back to, I know you said this is like a prime time. It's a prime opportunity in the current economic cycle. Do you try and time your investments based on economic cycles?
Timing a market is difficult. It really is. There's you'll never get it right. Everybody wants the perfect timing. Everybody wants it right. I believe there's shades of grayness when it comes to timing. Now, I'm also not here to tell people is timing's not important. It 100% is important. It's important. Like, for example, I bought an entire, let's call it 40 places in the year 2008. It was more than 40 probably. I more than doubled my portfolio in 1 year back in 2008. And then after that, everything went completely down for decades. Things were flat and down for decades. You don't think that I would have, going back to 2008, tapped myself on the shoulder and said, yeah, you might want to slow down. The market's a little bit too much froth. It's setting a record for unaffordability. There's a whole bunch of things coming in. Russ, you might not want to double your portfolio at a peak. And that's one of the things I've been advising a lot of my clients. Like, and I can't tell exactly, like, there's no way I can pinpoint down, but I'm seeing a few things surface that I've seen back in 2007, 2008 in the Alberta marketplace. I'm seeing those kind of things form in BC and Ontario in many select markets. In February of 2021, I started advising my inner circle people to, gang, take a look at this pay attention. Here are the things that are forming. You might want to sell off some of your bad properties in those marketplace. I would not want to take a long-term position. If you're going to do it short the market in BC and Ontario, short market meaning maybe do a flip and do something quick, in and out, capitalize on some froth. But now's the time to start divesting of the bad properties in BC and Ontario and start moving those money and that capital back into Alberta again. Was I close on February 2021? No, I was about a year off, to be honest. But March of 2022, the market started to dive and started to dip in those marketplaces. And then all of a sudden they had a little revival again, and they started on the upswing again. And those markets with the latest rental interest rate increase just recently have gone cold again. I wouldn't be surprised if you start seeing prices come off in those unaffordable markets in Ontario and BC. I wouldn't be surprised if you start seeing that for at least the next year. And my prediction for those marketplaces, and I'm going to go way out on a limb on this, and only time will tell if I'm right. I don't see a fundamental collapse. Now, the reason why I don't see a fundamental collapse is because there's such a housing shortage. There's so many people moving into those marketplaces. They're very desirable for people to want to live there. And there's such a shortage of housing. So I don't see a fundamental collapse, but I also see on the top side that there is some huge headwinds, and those huge headwinds are the affordability numbers, that people, first-time homebuyers, just can't afford to buy a house in those marketplaces. Yeah. So I don't see a collapse, and I don't see a giant spike in there. So what does that say? To me, that says there's probably going to be lots of years of flatness in Ontario and British Columbia. And those two markets of Ontario and BC are so difficult to be landlords, to be rental housing providers in those marketplaces. If you ain't getting aggressive asset appreciation numbers in those marketplaces, how excited are you about being a rental housing provider in those marketplaces where it's going to be flat maybe for years to come? So many people in those marketplaces who have seen some really good gains, maybe it's time to pull some of those gains off the table and get it invested into the next market that's going to start poised to go up. And I believe that's going to be Alberta. So I answered your question, but didn't answer your question. The simplest way to say is I cannot time exactly when it's going to happen. I can probably tell within a year or two about things. And you only know when you actually look back on time, right? To truly look back on time. But I'm quite confident on what, and I have my certainty about what I believe is going to happen, and I'm letting my actions dictate that going forward. So will I be right or wrong? Yes, I will be right and wrong all at the same time, but I do have some certainty that I believe it gives me enough footing and confidence to move forward.
That's a great answer. And Russell, I was going to ask you, one of the questions I had in mind was, you invest throughout Canada, and places like BC, Ontario, they're well known for appreciation, and places like Alberta is more known for cash flow, right? And I wanted to ask you how you go about balancing that portfolio of assets, between the appreciation and the cash flow. But after your answer, I'm leaning more towards you probably do it more on a large scale economic factor, like what's going on would dictate where you push your capital or your focus towards. Yep. Am I right on that?
100%. So there's, I'm just trying to remember all the conversation things that I can say with that. That's a big question, and an excellent question, by the way. Okay. So number one, I'll give you a reason why a lot of BC markets and Ontario markets have probably lots of appreciation. And that typically comes down to the governance and the government. And it's a lot of those key markets are landlocked. Meaning where I live here in BC, in Vancouver, a suburb of Vancouver, there's a US border on one side, there's an ocean on another, and there's mountains on the north side. So really there's only a couple directions you can go, and that's up, and that's maybe down the valley. So it's landlocked. The land value is very high. Okay. Now in Edmonton, typically up until recently, they were a little bit more generous on subdivisions and stuff. Like they literally would sit there and go, oh, look, a canola field out there on the other side of the Anthony Henday. The only thing I can see next on going out west is, well, we can keep going until we hit Jasper, right? And literally, we had knocked down a canola field, and you got a new subdivision, and the urban sprawl was crazy. Um, that was a risk that I saw in Edmonton. But if you actually dive into the economics of the city, they've actually put in their plan. There, you can go find it. The places there, what is it? The Edmonton Economic Development Plan. They have an entire growth plan. They have a name for it, which is escaping me here. But they have a detailed plan. And their detailed plan is they don't want to go out. They believe the footprint of Edmonton is as large as they would like it right now, because as you start building out, you need more roads, you need more sewers. The garbage trucks have to go further. They're just spreading out their tax base over a wider area, and it just costs more money to do that. So what they've now done is they're now densifying in. That's why they're approving a lot of those infill developments. They're actually, think about it from a standpoint, from a city planner, you can densify inner city. You don't have to put any more sewers in. You don't have to put any more roads in. Your garbage trucks don't have to potentially go any further. You just have to, and then you increase your tax base. So you make more money and invest less. That makes sense. So that's one of the reasons why I believe the land values in certain areas in Alberta, Edmonton, Calgary, are going to start going up as well, because they're putting artificial land locks on things. Okay, so that's the first one, is appreciation versus that, different markets. Now, the cash flow, I view cash flow as not until back up. Once the properties are free and clear with no mortgages on it, that's when you can actually have free flowing cash flow to live off of. While you still have mortgages on the properties, cash flow, in my personal opinion, is risk mitigation. Okay. You need to have good, strong cash flow in order to pour back into your properties to be able to, with the maintenance, and if you have any challenging time on economic cycles that happen, or tenancies or repairs, that cash flow can get reinvested back in, and you can hold the property longer if you have the cash flow to hold it. Okay. So you can hold the property while you're waiting for the appreciation, and while the mortgages are being paid down, you can afford to hold it. In those markets out in Ontario and British Columbia, the only model that works is speculation, because they're not cash flowing. You are essentially feeding that property every single month, and thank goodness that you can sell it for more in the future. But what happens if you can't, right? What happens if you can't? Like, honestly, that, in my opinion, is not a good investment. And it just truly comes down to the difference between investing versus speculating. Alberta is investing. Those other markets are speculating. Now, don't get me wrong. I'm speculating that Alberta is going to go up in value. I'm speculating that it's going to be worth more when I come time to sell. But I don't need that speculation in order to hold the property over the next 7 to 10 to 15 years.
There's a lot of gold in that, Russell. You know, when I talk to newer investors versus older investors, the newer ones, their goals are, I want to get a few rental properties and I want to live off the cash flow. And oftentimes I tell them exactly what you said, is it is risky, because, you know, properties that were cash flowing last year before all the interest hikes, are, some of them aren't cash flowing, or they barely cash flowing, or they cash flow negative. And when I speak to seasoned investors, a lot of them say that they don't take the cash flow, they don't use the cash flow. That just goes into their reserve fund to hold the property longer, because, you know, you have these big unexpected expenses that pop up, or there could be an economic shift, and, you know, that helps you hold on to the property. So I absolutely love that. And to be honest, when I first got exposed to the realm of investing, I was also under that opinion, like, how many properties do I need to own so that covers my living expenses? And I've had that shift.
Yeah. Now, don't get me wrong when I say that. I'm just being real, and honestly, don't get me wrong. I wish the cash flow, I want the cash flow to be as high as possible, and I want to be able to take big giant vacations based upon the cash flow, and make the joke sometimes, if there is surplus cash flow at the end of the year, that we distribute it to partners. We say and we do it around Christmas. We say Christmas is on the house this year, right? Don't get me wrong. I if it's there, by all means, we're distributing. But I also am just very mindful at the same time about that. We have to be prepared if it's that we have to put some capital back in. And that's one of the reasons why I've also shifted into new construction. Like I've shifted into new construction properties because if you actually can purpose build your property, purpose build it with the right materials, the right design, the right layout, the right suite mix, the right sizes. If you can purpose build it and it's under warranty, right? You literally have the new home warranty of a lot of those big ticket items are covered. You actually can run a little tighter on your reserve fund because the property is brand new. And arguably speaking, for the first potentially 5 to 7 years, your expenses will be next to nothing on a maintenance side of things. And don't get me wrong, you always have maintenance expenses, but they could be next to nothing. And I know this for a fact because I have new properties and I have 45-year-old townhomes at the same time. And on my year-end statements, it is as plain as black and white which ones are bad performers and which ones are the good performers. And the new properties, um, they just perform really well. Like, and I'll give a real life example. Let's do a real life example. This past winter, Edmonton, it was unfortunately minus 400 degrees below zero. Right? The furnace crapped out on one of my new things. It just stopped working. Okay. And so the tenant phoned the property manager. The property manager phoned over to for the warranty because it was still under warranty. It was still brand new, essentially a brand new furnace within a couple of years. A warranty call was put in. They came out. They fixed it under warranty. I paid a little extra because I wanted to have a rush, or I wanted to have it rush fixed, and it was a couple $100 at the most. I think it was maybe 250, maybe 300 at the most. If that was on one of my older properties, I would have been probably spending $3,000-$4,000 to probably have to put a new furnace in because the furnaces are old. So from a time perspective, tenant phoned property manager sent me an email note. I replied with 2 email notes and it was handled. So it was none of my time and it was a very little expense and a good experience for everybody, owner, property manager, and tenant. But if that was one of my older places and I had to repair a furnace in the middle of winter, good luck trying to find somebody to do it. And the tenants are, freezing at the same time and all that kind of stuff too. So just pivoted over to new construction and it was like a breath of fresh air when I did that.
Absolutely, because there's no deferred maintenance that you have to account for. So, everything has a longer lifespan. Of course, things happen, like you mentioned, but in general, you can afford to have that lower reserve.
Yep. It goes back to just risk mitigation. And I have these conversations all the time and I have these conversations with myself. I will always sit there and I'll ask, what if? Like what can go wrong? What happens if this? What happens if this? What happens if this? And I really just kind of dump it all on the table about what can go wrong. Okay. And then I sit there and go, okay, that's an honest, healthy conversation to have. Now, how do we mitigate each of those things? And that's just what we've been doing this over 23 years is slowly, I can't say it'll be 100% risk mitigated, but I literally try to clean up the system each and every day to try to have it as virtually as low as risk as possible. Because, I'm getting a little older and the runway ain't as long, 1 or 2 missteps and when the runway is a little shorter, those are pretty devastating when you get a little bit older. So, some fun, just having an awful lot of fun with that.
I think that's why you are known as the JV Jedi, just because that's one thing that your partners are going to ask you. What if this goes wrong? What if that goes wrong? And if you've kind of accounted for all of that, it helps with their mind at ease. It's time for one of my favorite segments of the show, and I call this time capsule. Okay, so let's imagine that you stumbled across a time machine that allows you to travel back and forth in time. Can't change anything, but you can give and receive advice from your younger or older self. First, let's go back to when you were 18. What advice would you give your younger self with the knowledge you have now? Now, this can be within business, investing, your personal life in general, or just a combination of them all.
Yeah. Okay. So the advice, if I actually, great question, first of all. And if I actually pragmatically really thought about it, the advice that I would give to my 18-year-old self, I think my 18-year-old self would have been too stupid to hear it and not would have done anything with it. So first and foremost,
let's go 30-year-old.
No, I'm gonna answer that question. I would tell my 18-year-old self the following. Instead of giving any specifics of things, I would just tell the 18-year-old self that, you're stronger than you think. You have tremendous amount of gifts that you've been given, and you have an incredible opportunity and a responsibility in front of you that lays there because you've been blessed with so many amazing people. And the best advice I would give my 18-year self is be very open when old 50-year-old people come and talk to you and give you advice, and don't be so stupid and close-minded not to listen to it. So listen to the people that have been down there before. You don't know everything. You don't. Listen to the people that have been down it. You don't have to take all their wisdom at gospel, but don't be close-minded to those people from the future that are coming back to tell you some really important lessons to learn. And at the same time, the specific thing I would say with that is, 18-year-old Russ, your hair is falling out. That's okay. Peaceful acceptance. Shave your head earlier than you thought because you have a really nice head, and you'll look better with a bald head than when you will with your hairline. So those are the two pieces of advice I'd give them.
I love both. I love both, Ross. Honestly, firstly, yeah, you don't have to learn lessons from your own mistakes. And I think everyone has lessons that you can learn from. Now, the second piece of advice I love as well, because I've always said to myself, I even said to my wife, like, if there ever comes a point where you feel like I should call it, let me know. If it starts at the back and I can't see it, I want to know. I'd rather just pull a Vin Diesel, Hopefully by then I have the muscle to support it. But I love that.
Yeah.
Now, looking ahead to your 80th birthday, what advice do you imagine your future self would offer your present self at your current age?
Wow, my future self, what would I offer? I would, first and foremost, I would thank him. I would thank my 80-year-old self for all the lessons, the easy ones and the painful ones that we've put through. I would just be pure. I'd come from a heart space and I would be in pure gratitude. I would thank my 80-year-old self for making some decisions, making the tough decisions, developing the skills, meeting the right people, and getting that strength to when things look sometimes quite dire and things look quite difficult, that just stuck to it. And you know what? 80-year-old self, nice guys, potentially, they always say nice guys finish last. Maybe nice guys eventually maybe lose a battle, but they always will win the war. So congratulations, 80-year-old self, that you stuck to your guns. You were truly authentic to who you were. And thank you on behalf of the million people that you've impacted over the years. I wanted to just thank you for that.
I love that, Ross. And to be honest, that wasn't even what I asked, but I love that answer even better.
Did I answer it wrongly?
You did it the wrong way, but to be honest, I feel like maybe that should be a question because I love that. I love the mental space. Honestly, that was
sorry. I thought I was going into the future and talking to my 80-year-old self, and I was
thinking
them.
But
Okay,
what would your 80-year-old self tell you now? Like, if you had to put yourself in your 80-year-old self's shoes, what advice do you think they would give you? But no, I love that. That was a brilliant answer, man.
Oh, thank you. I guess I answered it rightly the wrong way.
Just
I guess
the wrong way around. Yeah.
Hey, do you mind if I have a final? I know I don't want to jump over you here a second, but I do have some final thoughts I want to share with some people here, and I want to be respectful of your time. So I know I asked something before. Is I always do a lot of the what ifs. What if something can go wrong, and what if we need to mitigate this, and what if we don't do this, and what happens here, and whatever. The last thing I'm going to share with everybody is the what if question is very powerful, but it goes both directions. Most people will always come out from a standpoint of what can go wrong. What if this goes wrong? I actually tell people to think about what if it goes right? What if you do make the right decision? What if you do jump in with both feet? What if you do learn how this game works? What if you meet the right people on your journey? You don't even know the true power of what you can accomplish by asking, what if it goes right? And by all means, just ask that better question. What if? What if this all works out? What if I take the action? What if I make the decision? What if I go ask out the girl that on that date when I see her across the room? What if I buy this piece of property and in 20 years' time it goes from 1.8 to 5.2? What if is a very powerful question on the positive side as well.
I couldn't agree more. Just looking back at our conversation, the one regret that you mentioned wasn't a regret from doing something, but from not doing it and not jumping on that opportunity, right? So absolutely, we regret the things we don't do more than the things that we do.
I
It's a
agree.
super powerful question. Ask better questions, get better answers. I love that. I love that. Thank you for adding that
Yeah.
bit in. Honestly, thank you. Now, for all the listeners out there, this isn't where the fun ends. I'm leaving all of Russell's information down below, so go check him out. As I'm sure you can tell, won't be disappointed. But Russell, I wanted to thank you for coming on and sharing your remarkable insights. Honestly, this was super fun. I'd love to do it again.
Yeah. Honored to serve anytime, my friend. Thank you.
Thank you for tuning in to Building Wealth Through Real Estate. If you're interested in learning how to attract joint venture partners to help you grow your real estate portfolio, then you don't want to miss my interview with Mike Ponte. This is your host, Alray Noble, signing off.